To build anything that truly lasts, it takes time.
Show right now. Ashish, hi, morning. Good to have you on the show as always. I remember when we were talking about in March, you were saying don't be so pessimistic. The markets will improve and the second half is going to be good. Do you think we've reached the pinnacle of that? Is all the good news already in the price now?
Hi, good morning. Thanks for having me back. So I think we actually look at India market from our own lens, and the Indian market has, you're right, done quite well since March. But actually, if you look in the context of global markets, India YTD is actually underperform many global markets. If you look at most of the emerging market universe or even the Asian markets, whether you look at Korea, Taiwan, Brazil, most of the markets are actually year to date in dollar terms up anywhere between 20% to 35%. So we are actually in the midst of a major global equity rally. In the last couple of months, even the US market, as you would have seen, has clawed back most of its losses that were there in the past 6 months. So in that sense, the Indian market is not standing out in the global context. Actually, what is interesting is that despite this relative underperformance, year-to-date foreign flows to the market have still been lackluster, right? So since April, we have seen foreign flows turning positive, but they have not been very strong. If I recollect correctly, in the last 3 months, we have had only about $3.5 billion of net FII inflows. And so I think we have to look at our market performance in the broader context of the global equity market rally. We cannot be complacent given that there is a lot of uncertainty still out there. Since beginning of the year, major macro events have played out, whether in terms of geopolitics and even on tariffs. And the impact of that has not been seen on the economic indicators. So, for example, US tariffs are up about, on average, about 13% since the beginning of the year, even after many of the rollbacks. And US CPI does not reflect that. So some of these things play out with a lag. So I think next couple of months, we need to see the economic indicators actually playing out, and then only we will be able to get a decisive direction for the market.
Right, lots to watch out for. Ashish, hi, morning. This is Nehi also joining in the conversation. Give us a sense of where do you believe valuations are headed when it comes to across the market caps, because you still believe that valuations may be slightly stretched, but where are some pockets where you believe that the valuations have come down significantly and could merit a relook rather?
So in terms of valuations, we are actually where we were 6 months ago. We haven't really seen a major change in valuations. Nifty is about 21, 22 times earnings. If you see some of the sectors that are demonstrating higher growth, whether they are in the mid-cap space or even the larger caps, so wherever the growth outlook is stronger, those stocks actually on a median basis are trading around 27, 28 times, right? So I think valuations are not inexpensive in the market. What is important is that we this year get the growth pickup that is being forecast. Last year, market earnings growth had come down to about 6-7%. This year, the expectation is that growth should pick up to about 11-12%. And a lot of it is actually hinging on a recovery in the second half. If we look at the trends in the first quarter on the macroeconomic trends in India, they have not really picked up. In fact, many of the consumption basket is still relatively slow, whether you look at FMCG or in your show, you were earlier talking about even consumer durables. We have seen even some of the high frequency indicators like GST collections moderating to about 6%. Power demand has also slowed, but some of that is seasonal because of the monsoon. And really, the big hope is that in the second half, on back of the good monsoon, as well as all the liquidity infusion and rate cuts that have happened in the last 6 months, there is a pickup in the economy, and that reflects in earnings. As of today, we are not seeing that. If you see even bank credit growth, that still continues to be in single digit despite the liquidity infusion. So I think we are placing a lot of expectations on a stronger second half, given some of these macroeconomic developments.
But so far from the earnings, Ashish, where is it that you're seeing a reflection of a pickup? And, one can clearly see that it's the large private banks. That's the way the wave is moving.
Yeah. So definitely, I think the large banks have come out with good results. I think some of the NBFCs as well as the mid-sized banks will also be big beneficiaries of both reduction in the delinquencies we had seen in the unsecured side last year. So as that cycle is rolling over, you should expect better credit costs for these players. And the other big impact will be the impact of rate cuts. Because if you look at many of the NBFCs, their incremental funding costs are down as much as 150 basis points compared to last year. Many of the mid-sized banks have sharply cut down not just their term deposit rates, but their savings deposit rate as well. And that will really help really provide a boost to their margins. So I think on the banking side, you are seeing a major reduction in funding costs, and that should benefit both the NBFCs and the mid-sized banks as well. Till now, really the play was only in the large banks, but I think you should see broader participation in the growth this year.
All right, and along with that, Ashish, when it comes to some of the other sectors, in case in point being cement, there too the experts are believing that the second half could actually be a little better with respect to the demand and the prices. Help us with your take on cement as well as industrials at this point in time.
So on cement, we have actually seen a recovery in profitability even in this quarter for many of the players. So EBITDA per ton has already started to improve. It's coming really on account of a very strong cost control demonstrated by the players, as well as improvement in pricing that we witnessed from March. I think what we need to carefully watch is what kind of demand pickup comes through, because a lot of these price increases that have happened in the past 3 months have not been supported by volume growth. So actually, if you see many of the results that have come out, the volume growth that companies have reported is negative. And I believe for sustainable increase in prices, we need to see the volumes coming back. As of now, those signs are not there. But again, this is the monsoon season, so it is expected that volumes will be muted. And really, post the monsoon season, September, October, trends will really tell us how sustainable this uptick in profitability on cement is. On industrials, I think we have a constructive view. We have seen many of the players continue to report actually very strong top line as well as margins. And that trend has sustained. In fact, on the industrial side, the margin trends have actually been better than what we have seen on the consumption side. So because of muted volume growth as well as increasing competition, many of the consumer companies have seen margins coming off. But actually on the industrial side, the earnings growth has been better, and that's reflected in the valuation. So if you see, most of the industrial companies are trading at multiples much better than their historic multiples, which is not the case on the consumption side.
Right, so that's your take on some of the sectors. But Ashish, while I was going through your fact sheet, I see that you have reduced some exposure to pharma while you still continue to like that sector. What's your take on pharma, given that there is a whole separate tariff announcement for that, and the overall tariff announcement for India is still an overhang for us? So what's your take on pharma, and which sub-pockets would you like from the space right now?
So within pharma, our focus actually has been more on healthcare, particularly on the hospital side, on CDMO plays. We have not been very strongly positioned on really the generic export. So really within healthcare, either it is the domestic pharma companies or the CDMO companies, and we are most positive on the hospital space.
All right, that's the take coming in on the pharma and some of the healthcare space. But Ashish, not liking autos at the moment, because barring M&M, I believe that there's no other major OEM that you seem to like at this point in time. Though some experts do believe that the second half of this fiscal can actually be better, especially for the two-wheelers, given the monsoon could be good, the rural sentiment could pick up. But what's your sense? What is that that is keeping you back from liking these names?
Sure. No, I think it's a combination of really the fact that where margins are for most of these players compared to history. So if you see, despite really lackluster growth, the margins of most of the players are already very high. And the multiples, in fact, here, despite the fact that the industry was not doing too well over the last 2-3 years, continue to be stressed. So we are actually underweight autos, and I think we believe that there are a better place for the recovery in consumption. And we want to look at places where when consumption recovers, you see both not just the volume upside, but also some margin upside.
Right. Okay, that's the take coming in the market. But Ashish, great to have you on the show and good to be speaking with you as always.
Thanks for having me.
Okay, that's the word coming in from the House of Access Mutual Fund. We're looking good for the market. Eternal, by the way, has a block deal, or rather has had a block deal. About 0.2% percentage of equity has already changed hands, and the stock has swiftly made it to that 300 level in